Before we begin, a quick disclaimer. I am not a licensed financial advisor, mortgage lender, or attorney, and the information provided in this presentation is for educational and informational purposes only. This video is not a substitute for professional financial or legal advice. You should always consult with a qualified professional before making any major financial decisions. The mortgage landscape can change, so please be sure to verify all information with your chosen professionals. The average American homebuyer will overpay for their mortgage by more than $60,000. Let me say that again. $60,000. That's a brand new car. A down payment on another property. Years of retirement savings. Gone. Wiped out. Not because they bought too much house or had a bad credit score, but because they made a few simple, avoidable mistakes right at the very beginning of the process. Mistakes that the lending industry quietly counts on you making. For the next few minutes, we are going to make sure you are not one of them. Imagine this for a second. You've done it. After months of searching, scrolling through listings, and visiting open houses, you found the one. The perfect home. It has the backyard for the dog, the school district you wanted, the kitchen that makes you want to actually learn how to cook. Your heart is pounding. You put in an offer, and after a nail-biting 48 hours, the seller accepts. It's happening. The dream is real. And then you have to get the mortgage. Suddenly, your dream turns into a nightmare. You're buried in a mountain of paperwork. You're hearing a blizzard of confusing terms like APR, PMI, DTI, LTV, escrow. It's an alphabet soup of financial jargon designed to make your head spin. The loan officer you're talking to is friendly, sure, but they're speaking a different language, and you find yourself just nodding along, hoping you're not agreeing to sell your firstborn child. The excitement you felt is replaced by a gnawing anxiety, a fear that you're going to mess this up, get a bad deal, or worse, lose the house of your dreams because you don't know what you're doing. That feeling, that confusion, and that fear ends today. Right here. Right now. Over this 10-part series, I am going to give you the complete playbook for navigating the American mortgage system. We are going to demystify the entire process from start to finish. We will turn that confusing jargon into simple, plain English. We'll expose the common traps and pitfalls that cost people tens of thousands of dollars. And we will give you the exact strategies, questions, and tools you need to walk into this process with unshakable confidence, secure the best possible deal, and save an incredible amount of money. This isn't just a guide. This is your shield and your sword for the biggest financial battle of your life. So, let's start at the absolute beginning with a question that seems almost too simple. What even is a mortgage? Forget all the complicated definitions. At its core, a mortgage is just a loan. That's it. But it's a special kind of loan because it's a secured loan. All that means is you're borrowing a huge pile of money to buy a house, and you're telling the lender, hey, if I fail to pay you back, you have my permission to take the house. The house is the security for the loan. It's the collateral. That's why lenders are willing to give you hundreds of thousands of dollars, because if things go wrong, they know they can get the asset back. You're essentially renting money from the bank to buy a house, and the interest they charge is the rental fee. Simple as that. Now, who are you renting this money from? This is the first place people get tripped up. You'll hear terms like banks, credit unions, mortgage brokers, and direct lenders. What's the difference? Let's make it easy. Think of it like buying a car. First, you have what are called direct lenders or retail lenders. These are your big national banks, think Chase, Bank of America, Wells Fargo, and your local community banks or credit unions. Going to them is like going directly to the Ford or Toyota dealership. They have their own specific products, in this case their own mortgage loans, and they can only sell you what they have on their lot. The person you talk to, the loan officer, works for that one bank. They're a specialist in their bank's products, but they can't offer you a deal from the bank across the street. Second, you have mortgage brokers. A mortgage broker is like an independent car buying expert. They don't work for Ford or Toyota. They work for you. You tell the broker, I need a reliable SUV with a good interest rate. And they go out and shop at dozens of different wholesale lenders, many of whom you've never even heard of, to find you the absolute best deal. They have access to a much wider variety of loan products and rates than a single bank does. They get paid a commission, usually by the lender, for bringing them your business. Their entire job is to connect you, the borrower, with the right lender for your specific situation. So which one is better? A bank or a broker? The honest answer is, it depends. Sometimes your personal bank where you've had a checking account for 20 years will give you a fantastic loyalty discount. Other times, a broker will dig up a little-known lender with a special program that saves you thousands. The single most important takeaway right now is knowing that you have options. You are not stuck with the first person you talk to. And that brings me to the most critical mindset shift you need to make before you even think about applying for a loan. It is the foundation of this entire series. You must understand this. The lender is not your friend. The loan officer is not your financial advisor. They are salespeople. They might be wonderful, kind, helpful people. But at the end of the day, their job is to sell you a product, a loan. They work for a business, and that business's goal is to make a profit from your loan. This is not a bad thing. It's just business. But you cannot walk into this process with the mindset that they are there to benevolently guide you to the best possible outcome for you. They are there to guide you to the best possible outcome for their company. Your job, and the job I'm going to teach you how to do, is to make these lenders compete for your business. You hold the power. You are the prize. You are bringing them hundreds of thousands of dollars in business over the next 30 years. You are not asking for a favor. You are a highly valuable customer. When you flip that switch in your brain, you stop being a passive, nervous applicant and become an empowered, savvy shopper. You stop asking, "Can you please give me a loan?" And you start asking, "Why should I give my business to you over your competitor?" This mindset is everything. It will be the difference between accepting the first offer you get and strategically shopping around to find a deal that saves you $60,000. It's the difference between being confused and being in control. So we know what a mortgage is. We know the key players, the banks and the brokers, and we have our new powerful mindset. Now, where do we actually begin the practical process? The first step everyone talks about is getting pre-approved. But there's a massive difference between a pre-qualification and a pre-approval. One is a nearly worthless piece of marketing, and the other is the golden ticket that allows you to confidently make an offer on your dream home. Getting this wrong can mean watching another buyer swoop in and steal your house right out from under you, all because their financing was more secure. And in our next part, I'm going to show you exactly how to get that golden ticket. That golden ticket is called a pre-approval letter. And it is, without a doubt, the single most important document you will get before you even think about looking at a single house. But here's the trap. There's a wolf in sheep's clothing out there called a pre-qualification, and it's designed to look and sound just like a pre-approval. But it is a cheap imitation, a financial mirage that will leave you stranded in the desert when it matters most. Let me be crystal clear. A pre-qualification is basically worthless. It's a 5-minute phone call or an online form where you tell a lender what you make and what you owe, and they spit out a number based on zero verification. They haven't seen your pay stubs, they haven't looked at your tax returns, they haven't pulled your full credit report. It's a pinky promise. And in the brutal world of real estate, a pinky promise will get you laughed out of an open house. A seller's agent sees a pre-qualification letter and they see a tourist, a window shopper. They see a deal that has a high chance of falling apart in 2 weeks, wasting everyone's time. A pre-approval, on the other hand, is the real deal. This is where you hand over your financial life to a lender for a full deep dive analysis. They will pull your FICO scores from all 3 credit bureaus. They will scrutinize your bank statements line by line. They will verify your employment and your income with your boss. They will run your numbers through the same automated underwriting systems that will eventually approve your final loan. It's a financial colonoscopy. It's invasive, it's a little uncomfortable, but it is absolutely necessary to find any problems before they become catastrophic. When a seller's agent sees a pre-approval letter from a reputable lender, they see a serious, qualified buyer. They see a check that is almost guaranteed to cash. That is your golden ticket. It transforms you from a maybe into a yes. So how do we get one? We do it by building your financial armor. We're going to assemble a case so strong, so undeniable, that a lender has no choice but to say yes. This process revolves around 4 core pillars. Get these 4 things right and you're in. The first pillar is your credit score. This is your financial report card. And lenders are the harshest graders you'll ever meet. You might check your score on a free app and see a 750, but lenders use a specific, often more conservative FICO score model. They'll pull reports from all 3 bureaus, Equifax, Experian, and TransUnion, and typically use the middle score of the 3. To even get in the game for most conventional loans, you need at least a 620. But 620 is the nosebleed section. You're in the stadium, but your interest rate is going to be painful. The sweet spot, the VIP box seats where you get the best rates and easiest approvals, starts around 740. If your score is lower than that, don't panic. But your first mission is to pull your full reports, dispute any errors, Pay down your credit card balances below 30% of their limits, and make every single payment on time from this moment forward. The second pillar is your income. Lenders don't care about the side hustle you get paid for in cash. They care about stable, predictable, and, most importantly, verifiable income. For most people with a W-2 job, this is straightforward. They want to see your last 2 years of employment history, ideally at the same company or at least in the same line of work. They'll ask for your last 30 days of pay stubs and your last 2 years of W-2s and tax returns. If you're self-employed, a freelancer, or a business owner, the bar is much higher. You're not a bad risk, you're just a more complicated one. They'll need 2 full years of business and personal tax returns, and they will average your net income, after all your write-offs, over those 24 months. This is a huge tripwire for entrepreneurs. You might have grossed $200,000, but if you wrote everything off and your tax return shows you only made $40,000, then as far as the bank is concerned, you make $40,000 a year. Period. The third pillar is your assets. This is the cash you have for your down payment and closing costs. And lenders are incredibly picky about where this money comes from. They want to see that it's your money, and that it has been sitting in your account for a while. They call this seasoned funds. They will demand your last 2 to 3 months of bank statements for every account you have, checking, savings, investment accounts. They will go through it with a fine-tooth comb. What are they looking for? Large, unusual, undocumented deposits. If you suddenly have $10,000 appear in your checking account a week before you apply for a mortgage, that's a massive red flag. Was it a loan from a relative they don't know about? Was it mattress money you just deposited? Every dollar has to have a paper trail. If your parents are gifting you money for the down payment, that's perfectly fine, but it requires a formal gift letter stating that the money is a gift and not a loan that needs to be repaid. Start gathering these funds into 1 or 2 accounts now and stop moving money around. And that brings us to the fourth and final pillar, your debt. This is the big one. A lender could see that you have a perfect 800 credit score, a 6-figure salary, and $100,000 in the bank, but they will still deny you if your debt is too high. They measure this using a magic number called your debt-to-income ratio, or DTI. It's simple, but it's ruthless. They take all of your monthly debt payments, your car loan, your student loans, your credit card minimum payments, and the new estimated mortgage payment for the house you want to buy, and they divide it by your gross monthly income, your salary before taxes. Let's say you make $6,000 a month. You have a $500 car payment and a $300 student loan payment. That's $800. The new house you want has a mortgage payment of $2,000. Your total monthly debts are now $2,800. You divide that by your $6,000 gross income, and your DTI is 46%. For most conventional loans, the absolute maximum DTI they will allow is 43%. In this scenario, despite having a great income, you'd be denied. You either need to pay off debt, or you need to look for a cheaper house. Understanding your DTI is non-negotiable. So, you've checked your credit, you understand your verifiable income, you've got your seasoned assets, and you've calculated your DTI. Now it's time to go into battle. You need to assemble your dossier. Create a folder on your computer and gather digital copies of everything. Your last 2 years of tax returns and W-2s, your last 30 days of pay stubs, your last 2 months of bank statements for all accounts, and a copy of your driver's license. Having this ready makes you look organized and serious, and it speeds up the process immensely. With your dossier in hand, you're ready to talk to a lender. Not 10 lenders. Just one for now. Our goal right now isn't to shop for the absolute best interest rate, that comes later, and I promise we will dive deep into that. Our goal today is to get that one powerful, rock-solid pre-approval letter. You can start with your local bank or a credit union, or you can ask a trusted real estate agent for a recommendation to a mortgage broker or a loan officer they've had success with. This person, your loan officer, will be your guide through this entire process. A good one is worth their weight in gold. You'll submit your application, upload your documents, and give them permission to pull your credit. Then you wait. It might take a few hours, it might take a day or two, but then an email will arrive. And attached to it will be your pre-approval letter. It will state, in black and white, on the lender's official letterhead, the exact loan amount you are approved for. This number is real. This is your budget. This is your power. You can now walk into any open house, not as a dreamer but as a contender. You have proven you can get the financing, and that puts you in a completely different league. But this letter, as powerful as it is also incredibly fragile. It's a conditional approval, and it comes with a set of unwritten rules. Breaking these rules, even accidentally, can cause your pre-approval to be revoked in an instant, often without you even knowing it until it's too late. There are financial moves you can make between now and closing day that seem completely innocent, but are the equivalent of taking a grenade to your home loan application. And in our next part, I'm going to walk you through the 7 deadly sins of mortgage applicants, the critical mistakes that can get your golden ticket ripped to shreds, forcing you to start this entire process all over again. Alright, let's dive right into the belly of the beast. You've got your pre-approval letter. It feels like a golden ticket to Willy Wonka's factory, a pass to the life you've been dreaming of. But here's the terrifying truth. That ticket is printed on the most fragile paper imaginable. One wrong move, one tiny misstep between now and closing day, and a stern-faced underwriter will rip it right in half. These mistakes, these 7 deadly sins, are committed every single day by hopeful homebuyers who just don't know any better. But you will. The first and most common sin is the sin of sudden splurging. You're excited, I get it. You're already picturing the perfect sectional sofa in your future living room, the shiny new fridge, the F-150 in the driveway. The temptation to go out and get ready for the new house is immense. Do not do it. From the moment you apply for a mortgage until the keys are physically in your hand, you are living in a financial quiet zone. Think of it as a monastery. Your bank account must become a place of silent, boring stability. Here's why. Lenders approve you based on a snapshot of your finances, specifically, your debt-to-income ratio, or DTI. When you go finance a $10,000 furniture set or lease a new car, you are adding a new monthly payment to your ledger. Your lender will pull your credit again, sometimes just hours before closing. When they see that new car payment, they recalculate your DTI. If that new debt pushes you over their strict limit, your loan is denied. It's over. That couch you bought just cost you the entire house. The rule is simple. No new credit cards, no new car loans, no new furniture financing. If you can't buy it with the cash you have on hand without dipping into your closing funds, you can't buy it. Live like a broke college student for a few more months so you can live like a homeowner for the rest of your life. The second deadly sin is the sin of the job hop. In a normal world, getting a promotion or a new, higher-paying job is cause for celebration. In the mortgage world, it's a 5-alarm fire. Lenders don't just care about how much you make. They are obsessed with the stability and predictability of your income. They want to see a consistent 2-year history in the same line of work. When you change jobs, especially if you switch industries or move from a salaried W-2 position to one that's commission-based or self-employed, you nuke that history. To an underwriter, you've just gone from being a predictable bet to a total wild card. Even if the new job pays more, they may not be able to use that income to qualify you until you've been there for a while. The absolute worst thing you can do is quit your job to start your own business right before buying a house. That's like a pilot jumping out of the cockpit mid-flight. If you are considering a job change, you must speak with your loan officer before you even think about giving your 2 weeks' notice. In some cases, a new salary job in the same industry is perfectly fine, but you need to get their blessing first. Don't surprise them. Sin number 3. The sin of the cash shuffle. This one trips up so many people who are getting help from family. Let's say your parents graciously gift you $20,000 for your down payment. Your first instinct is to just deposit that cash or check into your bank account. This is a catastrophic mistake. In the post-2008 financial world, every single dollar used for a down payment must be sourced and seasoned. That means the lender needs to see exactly where it came from and verify it's not a secret loan you have to pay back. A giant, mysterious cash deposit is the reddest of red flags. It looks like money laundering or an undisclosed debt. The underwriter will demand a paper trail. If you can't provide one, they will completely disregard that money, and you'll no longer have enough for your down payment. The correct way to handle a gift is with a formal gift letter, a document your lender provides, which your family member signs stating the money is a true gift with no expectation of repayment. They'll also need to provide a bank statement showing they had the funds to give. It feels intrusive, but it's non-negotiable. Next up, the 4th sin. The sin of credit co-signing. Your brother needs a car. Your best friend wants to get her first credit card. They have shaky credit, so they ask you to do them a favor and co-sign. You think, I'm not the one making the payments, so what's the harm? The harm is that in the eyes of your mortgage lender, that debt is 100% yours. When you co-sign, you are legally on the hook for the entire amount. That full monthly payment for your brother's car is now factored into your debt-to-income ratio, even if you never pay a dime. This single act of kindness can instantly disqualify you from your mortgage. The time to be a good Samaritan is after you close on your house, not before. Until then, your only financial responsibility is to yourself and your home loan application. This brings us to sin number 5, the sin of silent suffering. The mortgage process is a marathon of paperwork. Your loan officer and the underwriter are going to ask you for documents. They'll ask for bank statements, pay stubs, tax returns, and then, just when you think you're done, they'll ask for them again. They'll ask for a letter explaining that one weird deposit from 3 months ago. They will be relentless. Ignoring their emails or taking a week to respond is a deal killer. Time is your enemy in a real estate transaction. You have deadlines in your contract for loan approval and closing. Every day you delay gives the underwriter less time to work on your file. This can cause you to miss your closing date, which could put your earnest money deposit at risk and potentially allow the seller to walk away from the deal entirely. When your lender asks for something, drop everything and get it to them. Think of them as the most demanding boss you've ever had. Keep them happy and you'll get to the finish line. The 6th deadly sin is the sin of credit card chaos. Your credit score is the holy number in this entire process. You need to protect it like a dragon guards its gold. Many people think, I should pay off and close some of my old credit cards to look more responsible. Wrong. Closing old accounts can actually hurt your score. It reduces your overall available credit, which increases your credit utilization ratio, a key factor in your score. On the flip side, don't open any new credit cards either, not even that store card that promises you 20% off a new lawnmower. Opening a new account puts a hard inquiry on your report and lowers the average age of your accounts, both of which can cause your score to dip. The mission is to keep your credit profile perfectly, boringly static. Pay your bills on time, keep your balances low, and don't make any changes. Just let it be. And finally, the 7th deadly sin, the sin of rate chasing. You've locked in a rate with your lender. You're deep into the underwriting process. Then you get a slick ad in the mail from another company promising a rate that's 1/8 of a point lower. The temptation to jump ship to save a few bucks a month is powerful. Be very, very careful. Switching lenders midstream is a logistical nightmare. It means starting the entire application process from scratch. A new application, a new credit pull, resubmitting all your documents, and most importantly, ordering a new appraisal. This can take weeks, and you probably don't have weeks. If you can't close by the date on your purchase contract, the seller can cancel the deal, keep your deposit, and sell the house to someone else. That 1/8 of a point you were chasing just cost you your dream home. Do all of your rate shopping up front before you sign a purchase agreement. Once you're under contract, you need to be loyal to your chosen lender unless they give you a major reason not to be. These 7 sins are the most common, most lethal, and most avoidable traps in the home buying journey. They aren't complicated rules, but they require discipline. For the next 30 to 60 days, your financial life isn't your own. It belongs to the underwriter. Your job is to be stable, predictable, and boring. Be a ghost. Make no waves. If you can do that, you'll sail smoothly to the closing table. But now that you know what not to do, how do you actually find the right person to guide you through this process? How do you choose a lender who has your back instead of one who just sees you as a commission check? That's where we're going next. We're going to demystify the cast of characters in the mortgage world, from brokers to bankers to online lenders, and show you how to pick the perfect partner for your journey. Alright, let's pull back the curtain. Imagine you're about to climb Mount Everest. You wouldn't just grab the first guide you see on the street. You'd want to know, have they been to the summit? Do they know the hidden crevasses? Do they work for the mountain? Or do they work for you? Getting a mortgage is your financial Everest, and choosing your lender is choosing your guide. They fall into 3 main camps, and knowing the difference is the most critical decision you'll make in this entire process. First up, we have the most familiar face. The direct lender, often your local bank or credit union. This is the Chase, the Bank of America, the Wells Fargo, or the neighborhood credit union where you have your checking account. The appeal here is obvious. It's comfortable. It's the guide you already know. You walk into a familiar building, talk to a person in a suit, and it feels safe, established, and secure. If you're a longtime customer with a healthy amount of money in their bank, they might even offer you relationship pricing, a slight discount on your rate or fees as a thank you for your loyalty. The process can feel straightforward because they have a massive, well-oiled machine designed to handle one thing: their own products. But that's the catch. It's a massive machine that only sells one brand. Going to a big bank for a mortgage is like going to a Ford dealership and asking to see their best sedans. They will show you a fantastic Ford Fusion. They will tell you all about its features, its reliability, its warranty. They will never ever tell you that a Honda Accord down the street might be a better fit for your family and $1,000 cheaper. They can't. They are legally and professionally bound to sell you their product. Their loan officers are employees of the bank. Their primary duty is to the bank's bottom line, not yours. If your financial picture is anything but a perfect W-2 800 credit score snapshot, you might find their rigid, one-size-fits-all underwriting process unforgiving. You are a number in a very, very large system. So the direct lender is your company man guide. Reliable, predictable, and safe if you fit their exact mold. But they only know one path up the mountain, their path. And if you stumble, they might just leave you at base camp. Next, we have the polar opposite, the mortgage broker. This is your independent guide, your seasoned Sherpa. A mortgage broker doesn't work for any single bank. In fact, they don't lend any money at all. They are a matchmaker. Their job is to take your unique financial story, your income, your credit, your goals, and shop it to dozens of different wholesale lenders, many of whom you've never even heard of. These are the lenders who don't have fancy retail branches. They compete behind the scenes on one thing and one thing only, offering the best rates and programs. This is the broker's superpower. While the bank can only offer you the Ford Fusion, the broker can show you the Ford, the Honda, the Toyota, and that obscure but brilliant Subaru that's perfect for the weird financial weather you're in. Are you self-employed with fluctuating income? A good broker knows the 3 lenders in the country who specialize in that. Have a credit score that's a little bruised? They know which lender is more forgiving about that specific issue. You fill out one application, and they do all the legwork, creating a bidding war for your business. By law, a broker has a fiduciary duty to you, the borrower. They are legally obligated to act in your best interest. Their success is tied directly to your success. If they don't find you a loan that closes, they don't get paid. Now, it's not a perfect world. The quality of brokers can vary wildly. A fantastic broker is the single greatest asset you can have. A bad one can be a communication black hole. And because they're a middleman, they don't have the final say. The ultimate lender's underwriter does. A great broker manages that relationship for you, fighting on your behalf. A bad one just passes messages back and forth. You are hiring an individual's expertise, so you have to vet them carefully. The mortgage broker is your true mercenary guide. They work for you and only you, and they know every secret path and shortcut up the mountain. But you better make sure you've hired a seasoned veteran, not a rookie on their first climb. Finally, we have the new kid on the block, the online or digital lender. These are the tech giants, the rocket mortgages of the world. Their promise is seductive: speed, ease, and a slick app-based experience. No stuffy offices, no piles of paperwork. Just you, your phone, and a mortgage in minutes. And for some people, they are a fantastic option. Their streamlined, automated systems and lower overhead can often result in very competitive rates and low fees. You can upload your documents at midnight, track your loan's progress on a dashboard 24/7, and get a pre-approval faster than you can order a pizza. It feels modern, efficient, and transparent. But here's the trade-off for that speed. You're trading a dedicated guide for a powerful but inflexible robot. These systems are built for the perfect borrower. If you have a W-2 from a single job for the last 5 years, a 20% down payment, and flawless credit, their algorithm will love you. It will whisk you through the process, and it can be a wonderfully smooth experience. But what if you have a more complex story? What if you're a freelance graphic designer with 10 different 1099 forms? What if you just got a huge raise but it hasn't shown up on your pay stubs yet? The robot guide might just see a deviation from its programming and shut down. You'll likely be dealing with a call center, pass from one loan specialist to another, none of whom know the intimate details of your file. They are masters of volume, not nuance. When things go perfectly, they're unbeatable. But when a problem arises, and in real estate, problems always arise, you might find yourself desperately wishing you had a human being, a single point of contact, to call and advocate for you. So how do you choose? It's not about which one is best, but which one is best for you. Think of it like this. If you have a simple, straightforward financial life, a great relationship with your bank, and you value convenience above all else, the direct lender might be your comfortable, safe bet. If you are tech-savvy, your finances are clean as a whistle, and you want a fast, no-fuss digital experience with a great rate, the online lender could be an incredibly efficient choice. But if you want to ensure you are seeing the widest possible range of options, if your financial situation has any complexity whatsoever, or if you value having a dedicated expert who is legally on your side to navigate the inevitable turbulence of the mortgage process, a highly recommended mortgage broker is almost always the answer. Don't just pick one at random. You are hiring someone for the most important financial decision of your life. Interview at least one of each type. Ask them tough questions. Ask them, how do you get paid? A banker will say salary plus bonus. An online lender will say salary. A broker will explain their commission, which is paid by the lender. Ask them, what happens if my loan hits a snag in underwriting? Listen to their answers. Do they sound like they're reading from a script? Or do they sound like an experienced problem solver? Choosing your lender isn't just about finding the lowest interest rate online. It's about finding the right partner. The rate is just a number. The person, the guide who will get you through the paperwork, the underwriting, the appraisal, and all the way to the closing table is everything. And finding that person starts with understanding what kind of help you truly need. So, who are these guides? Where do you find them? It's not like there's a secret society of mortgage wizards you get invited to. The truth is, they operate out of different kinds of institutions, and choosing which door to walk through is the first critical decision you'll make. This choice sets the entire tone for your home buying journey. Think of it like this: you need to get across the country. You could take a giant, well-known airline, you could hire a private travel agent who finds you the best deal on a charter flight, or you could use a new, super-fast app that promises the cheapest ticket. They all get you to your destination, but the experience, the cost, and the support you get along the way will be radically different. Let's start with the most familiar face on the block: the big retail bank. This is your Chase, your Bank of America, your Wells Fargo. It's the place where you probably already have a checking account, a savings account, maybe even a credit card. The appeal here is obvious. It's comfortable. It's familiar. You can walk into a physical branch, sit down with a person in a suit and say, I bank here and I want to buy a house. There's a sense of security in that. They know your financial history, you know their brand, and there's a pre-existing relationship. Sometimes, they'll even offer you a small discount on your interest rate or closing costs, just for being a loyal customer. It feels like a one-stop shop, and for many people that convenience is king. But here's the crucial thing you have to understand about the big bank. They are a manufacturer that only sells its own products. When you go to that loan officer at Big Bank USA, they can only offer you mortgages from Big Bank USA. They have a set menu of loan options: their 30-year fixed, their 15-year fixed, their specific FHA program, and that's it. If your financial situation is a perfect round peg, and they happen to have a perfectly round hole, it can work out great. But what if you're a square peg? What if you're self-employed with fluctuating income? What if you have a unique credit situation, or need a niche loan product they don't offer? Well, they can't help you. They won't tell you that a different lender down the street has a program designed specifically for you. They'll just say, sorry, you don't qualify. End of story. The loan officer you're talking to, as nice as they may be, is an employee of the bank. Their primary loyalty is to the bank's products and guidelines, not necessarily to finding the absolute best solution for you on the open market. Now let's open door number 2. Behind this door is the mortgage broker. This is a character that a lot of first-time buyers don't fully understand. A mortgage broker is not a lender. They don't have a giant vault of their own money. Instead, think of them as a professional matchmaker. They are an independent guide who works for you. Their job is to take your specific financial story, your income, your credit, your assets, your goals, and shop it around to dozens of different wholesale lenders. These are lenders you've probably never heard of, names that aren't on giant stadiums because they don't work directly with the public. They work exclusively through brokers. Here's the magic of a good broker. You fill out one application. They pull your credit one time. Then they go to bat for you. They'll submit your file to lender A, who's known for having the best rates for people with high credit scores. They'll send it to lender B, who has a special program for gig economy workers. And they'll send it to lender C, who is more forgiving about a recent job change. They create a competitive environment where multiple lenders are fighting for your business. The broker then comes back to you and says, okay, here are the top 3 options. This one has the lowest rate, this one has the lowest closing costs, and this one can close 2 weeks faster. Based on what you told me, I think this is the best fit. What do you think? It's a completely different level of service. If you have a complex file, you're a freelancer, you have a recent bankruptcy, you're buying a unique property, a great broker can be the difference between getting a mortgage and getting a denial. They know the ins and outs of each lender's specific rulebook. But what's the catch? How do they get paid? Typically, they're paid by the wholesale lender that you ultimately choose. It's called lender-paid compensation, and it's built into the interest rate. So, the rate you see is the rate you get. The broker's fee is invisible to you because the lender pays them for bringing them a qualified, ready-to-go borrower. The key is to work with a reputable broker who is transparent about how they operate. A good one is an invaluable ally. A bad one can cause delays. The quality of your guide, in this case, matters immensely. Finally, we have our third option, the direct or online lender. These are the tech-savvy disruptors. Think of companies like Rocket Mortgage or Better.com. Their entire model is built on speed, efficiency, and a slick user interface. You can often go on their website at 10 p.m. in your pajamas, upload your documents, and get a preliminary decision in minutes. Because they have lower overhead, no fancy brick-and-mortar branches, they can often be incredibly competitive on interest rates and fees. For a certain type of borrower, this is a dream come true. If you have a straightforward financial life, a stable W-2 job, a great credit score, a 20% down payment, the online process can be incredibly smooth and save you money. You're what they call an A-paper borrower, and their automated systems are built for you. But that speed and automation can also be their biggest weakness. What happens when the computer algorithm flags something it doesn't understand? What happens when you have a question about your specific situation? Often, you're not dealing with a single dedicated loan officer. You're dealing with a call center. You might talk to Sarah on Monday, David on Tuesday, and a chatbot on Wednesday. There's no single person who knows your file inside and out. For a first-time buyer who needs guidance and reassurance, this can be terrifying. Small issues that a human loan officer would have solved with a quick phone call can sometimes spiral into major delays in an automated system. That super low rate they advertised might also have hidden costs, like discount points, that you didn't understand when you clicked accept. The online lender is a powerful tool, but it puts more of the responsibility on you to understand the process and make sure your file doesn't have any weird quirks. So we have the big bank, the comfortable but limited giant. We have the broker, the expert personal shopper. And we have the online lender, the fast and cheap tech company. Is that it? Not quite. There's one more worth mentioning. The credit union. Credit unions operate a bit like smaller, community-focused banks. They are nonprofits owned by their members, and their whole philosophy is centered around serving those members, not maximizing profits for shareholders. Because of this, they can often offer some of the best interest rates and lowest fees you'll find anywhere. The catch is, you have to be a member to use them. Membership is usually tied to your employer, your profession, or where you live. If you are eligible to join a credit union, they should absolutely be on your list of places to shop. They often provide that personal, small-town bank feel with the rates of a major competitor. So which path is right for you? There is no single correct answer. It's a deeply personal choice based on your priorities. Do you value an existing relationship and in-person service above all else? Start with your bank. Are you obsessed with getting the absolute lowest rate and are comfortable with a digital-first process? Check out the online lenders. Is your financial situation a little complicated? Or do you want an expert to shop the entire market on your behalf? A mortgage broker is likely your best bet. My advice? Talk to at least one of each. Get a feel for the process. See who takes the time to answer your questions, who explains things clearly, and who makes you feel like a partner, not just a number in a spreadsheet. Now, once you've chosen which guides you want to talk to, they are all going to immediately bring up the same critical first step. They're going to talk about getting pre-qualified or getting pre-approved. These two terms sound almost identical. Most beginners use them interchangeably, but this is a massive mistake. One of them is a powerful weapon that makes you a serious buyer in the eyes of real estate agents and sellers. It's the golden ticket that lets you make an offer on your dream home. The other is little more than an educated guess, barely worth the paper it's printed on. Understanding the profound difference between them is the key to starting your house hunt with confidence and power. And that's exactly what we're going to break down next. Let's start with a simple analogy. Imagine you feel sick. You call a doctor and say, "Hey doc, I've got a cough and a slight fever." Based on that phone call alone, the doctor might say, "It sounds like you might have a common cold. You can probably afford to take one day off work." That is a pre-qualification. It's a quick opinion based on information you provided, with zero verification. Now imagine you go into the doctor's office. They take your temperature, listen to your lungs, run blood work, and do a full physical exam. After all that, they look at the results and say, "Okay, you have a confirmed case of bronchitis. We are writing you a prescription for this specific antibiotic, and you are cleared to return to work in 5 days." That is a pre-approval. One is a guess. the other is a diagnosis. One is a conversation, the other is a commitment. When you get pre-qualified for a mortgage, you're having that phone call. You tell a lender your approximate income, your estimated credit score, and what you think your debts are. The lender plugs those numbers into a calculator and spits out a letter that says, based on what you told us, you can probably afford a house up to this price. It's fast, it's easy, and it feels like progress. But here's the brutal truth. A pre-qualification letter is a marketing tool. It's designed to get you, the customer, in the door. It carries almost no weight with the seller because everyone in the real estate world knows it's based on unverified data. It's a maybe, a thought bubble, a starting point for a conversation and nothing more. Now let's talk about the pre-approval. This is where the game changes. This is where you go from a window shopper to a power buyer. A pre-approval is a conditional commitment from a lender to give you a loan for a specific amount. To get one, you have to go through the initial steps of the underwriting process. This isn't a phone call. This is the full physical exam. You will provide actual documentation. Your last 2 years of tax returns, recent pay stubs, W-2s, and bank statements. You'll give them permission to pull your full credit report from all 3 bureaus. They will scrutinize your debt-to-income ratio, verify your employment, and analyze your savings. It's more work. It's more invasive. And it is, without a doubt, one of the most powerful things you can do before you even start looking at houses online. Let me tell you a story about 2 buyers. Let's call them Peter and Jane. Peter is eager to get started. He calls a lender, gets a pre-qualification in 15 minutes for $400,000, and immediately starts scheduling home tours. He finds it, the perfect house. It has the big backyard for his dog, the updated kitchen. It's in the right school district. It's listed at $395,000. He's ecstatic. His pre-qualification letter says he can afford it. He makes an offer, and after a little back and forth, the seller accepts. Champagne corks are popping. Peter is on top of the world. Then he goes back to the lender to officially apply for the loan. Now the real work begins. The underwriter asks for his tax returns. Oh, Peter does some freelance work on the side that he gets paid for in cash, and his declared income on his taxes is actually $15,000 less per year than what he told the lender on the phone. Red flag. Then the underwriter pulls his full credit report. It turns out there's a 3-year-old medical bill for $800 that went to collections that Peter completely forgot about. His actual credit score isn't the 740 he thought it was. It's 680. Another red flag. The underwriter calculates his real debt-to-income ratio using his verified income and all the debts on his credit report, including a car payment he forgot to mention. The result? Peter doesn't qualify for $400,000. The maximum he can get is $350,000. The deal for his dream house collapses. He loses the house, he's out the money he spent on the inspection, and he's emotionally crushed. All because his approval was built on a foundation of sand. Now let's look at Jane. Jane is also eager, but she's methodical. She spends a week gathering her documents. She submits everything to her lender for a full pre-approval. The lender does a deep dive. They find that same forgotten medical bill in collections. But instead of it blowing up a deal, the lender calls Jane and says, "Hey, we need to take care of this. Here's how you can pay it off to improve your score." Jane takes care of it. The lender verifies her income from her W-2s and her tax returns. After a week of underwriting, the lender comes back with a rock-solid pre-approval letter. It says, "We, the bank, commit to lending Jane up to $425,000, provided the house appraises and passes inspection." Jane now starts her home search. She knows her exact budget. Not a guess, not an estimate. The exact number. She finds a beautiful home listed for $420,000. It's popular, and there are multiple offers. Peter, or someone like him, comes in with an offer of $425,000, attached to a flimsy pre-qualification letter. Jane offers the list price of $420,000, but her offer is attached to a full pre-approval letter from a reputable lender. Who do you think the seller is going to choose? The highest offer that might fall apart in 3 weeks? Or the slightly lower offer that is a virtual guarantee to close? 9 times out of 10 they're choosing Jane. Her pre-approval makes her offer nearly as strong as a cash offer. It tells the seller that she is serious, organized, and financially vetted. The deal is safe. Jane gets the house not because she offered the most money, but because she offered the most certainty. This is the fundamental difference. A pre-qualification is asking for permission. A pre-approval is a declaration of power. It changes your entire position at the negotiating table. But I know what you might be thinking. A full pre-approval? That sounds like a lot of work. And won't they do a hard pull on my credit? I've heard that hurts my score. These are valid concerns. Let's tackle them head-on. Yes, a pre-approval requires a hard credit inquiry, which can temporarily dip your credit score by a few points. But here's the crucial piece of information most people don't know. The credit scoring models are smart. They know you're shopping for a mortgage. Any mortgage-related hard inquiries that occur within a 30 to 45-day window are bundled together and treated as a single event. This means you can, and absolutely should, apply for a pre-approval with 3 or 4 different lenders, a big bank, a local credit union, a mortgage broker, to compare rates and fees, and it will have the same impact on your credit as applying with just one. That fear of damaging your score by shopping around is a myth. The small, temporary dip from one consolidated inquiry is an incredibly small price to pay for the certainty and negotiating power pre-approval gives you. Getting pre-approved does more than just make your offer stronger. Protects you. It uncovers any potential skeletons in your financial closet before you get emotionally attached to a home. It forces you to get your financial documents in order, making the final loan application process 1,000 times smoother. It gives you a crystal clear, realistic budget, so you're only looking at homes you know for a fact you can afford. You won't waste a single weekend touring houses that are out of your reach. So when a real estate agent asks if you're pre-approved, they're not just checking a box. They're asking if you're a serious player or just a tourist. When you submit an offer, that pre-approval letter is your ticket to entry. Without it, in a competitive market, you're barely in the game. It is the single most important step you can take to begin your home buying journey. It transforms you from a dreamer into a contender. So now you have your golden ticket. You've gone through the process, you have a pre-approval letter in hand, and you know your exact buying power. The question is, did you get it from the right place? Because the institution that gives you that pre-approval is just as important as the letter itself. You could go to a giant national bank, a small community credit union, or an independent mortgage broker who works with dozens of different lenders. Each one has a completely different set of pros and cons that can dramatically impact the interest rate you pay, the fees you're charged, and the smoothness of your entire home buying experience. Choosing your lender is the next critical decision on your path to homeownership, and understanding the differences between them is the key to not leaving thousands of dollars on the table. So you're standing at a crossroads. In front of you are 3 distinct paths, and at the end of each path is a potential lender holding the keys to your future home. But these paths are not created equal. One might be a smooth, paved superhighway, another, a scenic route with a few bumps, and the third could be a winding back road that leads to a hidden gem. The choice you make here isn't just about getting a loan. It's about the guide you choose for one of the most significant financial journeys of your life. Let's start with the most familiar path, the big retail banks. These are the household names you see on every street corner: Chase, Wells Fargo, Bank of America. It's likely where you have your checking account, your credit card, maybe even a car loan. The appeal here is immediate and powerful: comfort and convenience. You can literally walk into a branch you've been visiting for years, sit down with a person in a suit and say, "I'd like to talk about a mortgage." The pros are obvious. You have an existing relationship. They already have a lot of your financial information, which can sometimes streamline the initial application. They might even offer relationship discounts or special perks for being a longtime customer. Having a brick-and-mortar building to go to can feel incredibly reassuring, especially when you're dealing with such a large sum of money and a mountain of paperwork. If something gets confusing, you have a person and a place to go to for answers. Feels safe, feels known. But here's the catch. That safety and familiarity can come at a cost. Your local bank is a jack of all trades. They do checking, savings, credit cards, business loans, wealth management, and somewhere on that long list is mortgages. The person helping you might be a fantastic banker, but they aren't necessarily a dedicated mortgage specialist who lives and breathes the market every single day. Their primary job is to sell you their bank's products. They have a limited menu. If their specific mortgage options, their underwriting guidelines, or their rates aren't a perfect fit for you, they can't just offer you a better deal from a competitor down the street. They can only offer you what's on their shelf. This can lead to a take-it-or-leave-it situation. Furthermore, because these are massive bureaucratic institutions, the process can sometimes move at a glacial pace. Your file might get passed from department to department, And the personal touch you felt in that initial meeting can quickly fade once you're just a number in a corporate queue. So while it's a great place to start and get a baseline, stopping here would be like only visiting the first restaurant you see on a street famous for its food. Now let's look at the second path. The direct lenders, also known as mortgage bankers. Think Rocket Mortgage, LoanDepot, Better.com. These companies are the polar opposite of the jack-of-all-trades bank. They do one thing and one thing only: mortgages. This is their entire world. They don't have checking accounts or physical branches on every corner. They are lean, mean mortgage originating machines. They use their own funds or lines of credit to issue the loan directly to you. The biggest advantage here is specialization and, often, speed. Their entire process, from the slick online application to the final funding, is optimized for efficiency. They leverage technology in a way that many traditional banks just can't. You can often upload documents from your phone at 10 o'clock at night and get updates in real time. Because their overhead is lower, no expensive downtown branches to maintain, they can often be very competitive on interest rates and fees. Their loan officers are typically well-versed in the nuances of the mortgage world because it's all they do all day, every day. For a borrower with a straightforward financial profile, a good W-2 job, solid credit, standard down payment, this can be an incredibly smooth and fast experience. The potential downside? Just like the big banks, a direct lender is only selling its own products. They have their own set of loans, their own underwriting rules, and their own rate sheets. While they might have a wider variety of mortgage-specific options than a retail bank, you're still limited to their in-house offerings. If your situation is even slightly outside their standard box, maybe you're self-employed with fluctuating income, or you need a very specific type of jumbo loan, you might just get a flat no, with no other options presented. The experience can also feel more transactional and less personal. You might be communicating with a call center or a team of people rather than one dedicated person who knows your name and your story. Customer service can be a lottery. You might get a superstar loan officer, or you might get a rookie who's just trying to hit their monthly quota. This brings us to our third path, the winding road that can lead to the best view. The mortgage broker. A mortgage broker is fundamentally different from the first two. They don't work for a bank and they don't lend any money themselves. A mortgage broker is an independent professional who acts as your personal mortgage shopper. They are the matchmaker. Their job is to take your single application and, using their industry knowledge and network, shop it around to dozens of different wholesale lenders, many of whom you've never heard of and don't work directly with the public. The number one advantage of using a broker is access to choice. Massive choice. A broker isn't tied to one company's set of rules or rates. They can compare a huge variety of lenders to find the one that is the absolute best fit for your unique financial DNA. This is a game changer, especially for borrowers with less than perfect credit, those who are self-employed, or anyone in a unique situation that doesn't fit neatly into a big bank's algorithm. A good broker knows which lenders are best for FHA loans, which ones are aggressive on rates for military veterans, and which ones have programs for people with non-traditional income. They work for you, not the lender. Their incentive is to find you the best possible deal to close your loan and earn your future business and referrals. Because they operate in the wholesale market, they often have access to lower interest rates than what's advertised to the general public, which can save you a staggering amount of money over the life of the loan. So what's the catch? The quality of your experience is entirely dependent on the quality of the broker you choose. A fantastic, experienced broker is an invaluable advocate who will fight for you every step of the way. A bad one can be disorganized, a poor communicator, and turn your experience into a nightmare. Their compensation can also be a point of confusion. Brokers are typically paid by the lender in the form of a commission, and this fee is built into the interest rate. Sometimes they charge a flat origination fee to the borrower. It's crucial that you have a transparent conversation up front about how they get paid. You are placing a massive amount of trust in this one person to be your expert guide. So how do you choose? There is no single best option for everyone. It's about what's best for you. If you have a very straightforward financial life, you bank at a place where you're treated like a VIP, and you deeply value face-to-face interaction, starting with your retail bank makes a lot of sense. If you are tech-savvy, have a strong, easy-to-document application, and your top priority is a fast, streamlined digital experience, a direct lender could be a perfect match. But if you want to be absolutely certain you're seeing the widest possible range of options, if your financial picture has any complexity to it, or if you want an independent expert in your corner whose sole job is to advocate for your best interest, a mortgage broker is often the superior choice. The ultimate strategy, the one that guarantees you won't leave money on the table, is to not choose just one path. You need to explore. The single most important piece of advice in this entire series is this: you must shop around. Get a quote, a loan estimate to be specific, from at least 3 different sources. Try one from each category: your personal bank, a major online direct lender, and a highly rated local mortgage broker. Let them compete for your business. This is the only way to truly know you're getting the best rate, the best terms, and the best service for your situation. Getting these competing offers isn't just about comparing numbers. It's the first step in assembling the financial toolkit you'll need to actually go out and start looking at houses. Because before any real estate agent will take you seriously, before you can confidently make an offer on your dream home, you need to get one of the most powerful documents in the entire home buying process. You need to get pre-approved. This piece of paper is your golden ticket. It transforms you from a window shopper into a serious, qualified buyer, and getting it requires a whole new level of preparation. So, how do you get this golden ticket? You need to understand that the pre-approval process is not a casual conversation. It is a dress rehearsal for the main event, the final mortgage application. It's the lender's way of saying, let's see what you've really got. They're going to put your entire financial life under a microscope, and you need to be ready to hand them the slides. This is where the real work begins. The lender is about to ask you for a mountain of paperwork, and every single piece tells a part of your story. Let's break down the gauntlet you're about to run. First, they'll want proof of income. This isn't just you saying, I make this much. This is cold, hard proof. Get ready to produce your last 2 years of W-2s. Why 2 years? Because they want to see stability. A single good year could be a fluke. 2 years shows a pattern. They'll also demand your most recent pay stubs, usually covering the last 30 days. They'll scrutinize these for everything: your year-to-date earnings, any overtime, bonuses, or commissions. They want to know not just what you earn, but how you earn it. If you're self-employed or a contractor, the bar is even higher. Get ready to hand over your last 2 years of complete federal tax returns, including all schedules. They're going to want to see a consistent, reliable income stream. For them, a W-2 employee is a straightforward bet. A freelancer is a puzzle they need to solve, and your tax returns are the instruction manual. Next, they're digging into your assets. This means bank statements. All of them. Checking, savings, investment accounts, retirement accounts. They'll typically ask for the last 2 to 3 months of statements for every single account you have. And they will read every line. They're looking for 2 things. First, do you have enough cash for the down payment and closing costs? They want to see that this money is seasoned, meaning it's been sitting in your account for a while. A sudden massive deposit a week before you apply for a mortgage raises a giant red flag. Where did that $50,000 come from? Is it a gift? Is it an undisclosed loan from a relative? If it is a gift, they're going to require a formal gift letter from the person who gave you the money, stating explicitly that it's a gift and not a loan that needs to be repaid. They are terrified of you taking on secret debt to qualify for their debt. Second, they're analyzing your spending habits. Are you constantly overdrawing your account? Do you have regular payments going out to a lender they don't know about? They are building a complete picture of your financial discipline. Then comes your debt. They're going to pull your credit report, of course, but they also want you to list all your liabilities: car loans, student loans, credit card debt, any personal loans. You need to provide the name of the lender, your current balance, and your minimum monthly payment for every single one. Don't even think about leaving one out. They will find it. The purpose here is to calculate that all-important debt-to-income ratio we talked about earlier. They're matching your documented income against your documented debts to see how much room you have left for a mortgage payment. And finally, your personal information. Copies of your driver's license or passport, your social security number. They need to verify you are who you say you are. Now, as you gather this small library of your financial life, it's critical to understand the monumental difference between a pre-qualification and a pre-approval. Many people use these terms interchangeably, and that is a catastrophic mistake. A pre-qualification is a glorified guess. It's a 5-minute phone call where you tell a loan officer what you make and what you owe, and they give you a rough estimate of what you might be able to borrow. None of the information is verified. A pre-qualification letter is barely worth the paper it's printed on. It's like telling a personal trainer, you think you can run a 6-minute mile without ever stepping on a treadmill. It means nothing. A pre-approval, on the other hand, is a conditional commitment to lend. This is the real deal. This is when you've submitted that entire mountain of paperwork, and an actual human underwriter at the bank has reviewed it. They have verified your income, checked your assets, and pulled your credit. They have done the math. A pre-approval letter says, "We have examined this person's financial situation, and provided nothing changes and the house they choose meets our criteria, we will lend them X amount of dollars at Y interest rate." When a seller's agent sees a pre-qualification, they see a tourist. When they see a pre-approval, they see a buyer. So you go through the process. You submit every last document. You wait nervously for a few days, and then you get it, the pre-approval letter. You're holding the golden ticket. You feel invincible. You're ready to start kicking down doors and making offers. Stop. Right now is one of the most dangerous moments in the entire home buying process. Because getting pre-approved isn't the finish line. It's the start of a probationary period. From this moment until the day you get the keys, you are under a financial microscope. The lender has given you a conditional yes, and they are watching you, waiting for you to give them a reason to change it to a no. So let's talk about the sacred rules of protecting your pre-approval. These are the 10 commandments of not screwing up your mortgage. 1. Thou shalt not change jobs. Lenders worship stability. Quitting your job, even for a better paying one, can torpedo your loan at the last second. A new job means a new probationary period, which introduces risk. If you absolutely must change jobs, talk to your loan officer before you even think about giving notice. 2. Thou shalt not buy a new car. I cannot tell you how many people get pre-approved, feel confident, and go finance a $50,000 SUV. You just added a $700 monthly payment to your debt-to-income ratio. Your lender will find out when they do their final credit check right before closing, and they will deny your loan. The car can wait. 3. Thou shalt not open new credit cards. Every time you open a new line of credit, it dings your credit score and increases your available debt. Even if it's just a store card to save 10% on a new sofa for the house you don't even own yet. Don't do it. For thou shalt not close old credit cards. This seems counterintuitive, but closing an old account can actually hurt your score. It reduces your overall available credit and can shorten your credit history. Just leave everything as it is. 5. Thou shalt not make large undocumented cash deposits. We talked about this. That $10,000 your uncle gave you in cash at a barbecue? To a lender, that looks like a secret fraudulent loan. Every large deposit needs a clear paper trail. 6. Thou shalt not co-sign a loan for anyone. For your friend, for your cousin, for your dog. If you co-sign, that debt is legally yours, and it will show up on your credit report. 7. Thou shalt not miss any bill payments. This is obvious, but you'd be surprised. Pay everything on time every time. One late payment can drop your score just enough to change your interest rate or even disqualify you. 8. Thou shalt not spend your savings. That money you showed the lender for your down payment and closing costs? It needs to stay there. Don't decide to book a celebratory vacation or buy a new wardrobe. 9. Thou shalt not ignore your loan officer. If they ask for an updated bank statement or pay stub, send it immediately. Being slow to respond makes them nervous. And 10. Thou shalt shop for your mortgage in a tight window. This is a pro tip. When you apply for a pre-approval, the lender does a hard pull on your credit, which can temporarily lower your score. But the credit bureaus know people shop around for mortgages. So any mortgage-related hard pulls that happen within a 14 to 45-day window are treated as a single inquiry. This means you can and should get pre-approved with 3 or 4 different lenders: a big bank, a local credit union, a mortgage broker. This lets you compare their offers and interest rates without wrecking your credit score. Getting pre-approved is a major milestone. It gives you a firm budget and the power to make a serious offer. But this power is fragile. You have to protect it. You've proven you're a qualified buyer. Now you have to stay one. Because with that letter in hand, you're no longer just looking at houses online. You're ready to enter the arena. You're ready to actually find your home and make an offer. And knowing how to read and leverage that pre-approval letter is the key to crafting an offer that a seller simply can't refuse. So what does that letter actually do for you? Think of it less as a permission slip and more as a weapon. When you submit an offer on a house, you're not just competing on price. You're competing on certainty. A seller isn't just looking for the highest number. They're looking for the offer that is most likely to actually close, with the fewest headaches. An offer for $400,000 from a buyer with a flimsy, online-generated pre-qualification isn't nearly as attractive as an offer for $395,000 from a buyer with a rock-solid, fully underwritten pre-approval from a reputable local lender. Why? Because that second offer represents a sure thing. The seller sees your letter and knows you've already been through the financial ringer. They know a real human has scrutinized your income, your assets, and your credit. You're not a maybe. You're a high probability yes. In a bidding war, this can be the ace up your sleeve that lets you win without necessarily being the highest bidder. Your real estate agent will attach this letter to your offer, and it immediately signals to the seller and their agent. This person is serious. This person is capable. This is a deal you can count on. So you find it. The one. The house that makes you stop scrolling. You tour it and it feels like home. You work with your agent to craft the perfect offer. You decide on a price, the contingencies, the closing date. You sign the documents, your heart pounding in your chest, and your agent sends it off. And then you wait. And then you get the call. They accepted your offer. For a moment, it's pure euphoria. You did it. You're going to be a homeowner. You pop the champagne, you call your family, you post a picture on Instagram. But in the world of mortgages, this is not the finish line. This is the starting gun for the main event. You are now officially under contract. And a clock has started ticking. Usually, you have about 30 to 45 days to get your financing finalized and close the deal. And your lender, who has been patiently waiting in the wings, now sprints into action. The very first and most critical decision you'll make with your loan officer is whether to lock your interest rate. This is a monumental choice that can feel like trying to predict the stock market. An interest rate lock is a guarantee from the lender to hold a specific interest rate for you for a set period of time, typically for 30, 45, or 60 days. Once you lock, even if rates in the broader market shoot up tomorrow, your rate stays the same. Sounds great, right? Well, what if rates go down? If you're locked, you're stuck. You'll watch the news and see rates dropping, knowing you're locked in at a higher number. This is the gambler's dilemma. If you don't lock, you're floating your rate. You're betting that rates will fall between now and closing. If they do, you're a genius. You'll snag a lower rate and a lower monthly payment for the next 30 years. But if they go up, and they can go up fast, you're on the hook for that higher rate. So what do? There's no single right answer, but here's the professional advice. Don't try to be a market timing wizard. If you are comfortable with a monthly payment at the current rate, and you would be financially stressed if it went up even 0.25%, then lock it in. Peace of mind has immense value. A bird in the hand is worth two in the bush, especially when that bird determines your housing payment for the next 3 decades. Your loan officer will present you with the lock options. A 30-day lock might be free, but a 45 or 60-day lock might come with a small fee, because the lender is taking on more risk by guaranteeing that rate for a longer period. You want to make sure your lock period covers your entire closing timeline, with a little buffer just in case. With your rate locked, you now enter the most intense and scrutinized phase of the entire process: final underwriting. If pre-approval was the friendly interview, underwriting is the full-blown interrogation under a bright light. An underwriter is a highly trained professional at the bank whose sole job is to protect the lender from making a bad loan. They don't know you. They don't care about your dream of having a backyard for your dog. They care about one thing and one thing only: risk. Their job is to verify every single piece of information on your application with a fine-tooth comb and make the final decision to approve or deny your loan. This is where people get frustrated. The underwriter will ask for documents you feel like you've already submitted. They'll want your last 2 pay stubs again. They'll want your bank statements again. But this time they are looking at them with a microscope. They will analyze every single line item. They're going to see that $50 Venmo from your friend for pizza night. They're going to see the $2,000 transfer you made from your savings to your checking account. And they are going to demand an explanation and a paper trail for everything. That large deposit from your parents for the down payment? It's not enough that the money is in your account. You will need a formal gift letter, signed by them, stating that the money is a gift and not a loan that needs to be repaid. They may even need to provide their own bank statement to show where the funds came from. Why? Because an undisclosed loan would count as a new debt, which would change your debt-to-income ratio and could disqualify you. The underwriter is building a bulletproof case that you are a reliable borrower. They are creating a file that proves to the bank, and to any future auditors, that they followed every single rule and regulation to the letter. So when they ask for a letter explaining why your overtime pay was higher in March than in April, or why there's a $50 discrepancy on a credit card statement from 6 months ago, don't get angry. Get organized. Respond quickly, politely, and provide exactly what they ask for. Your loan officer is your coach in this process, helping you interpret and fulfill these requests. During this underwriting period, your life needs to become incredibly, almost absurdly boring financially. You are in a financial quiet period. There are 2 cardinal sins you absolutely cannot commit. First, do not change your employment status. Do not quit your job to start your dream business. Do not switch from a salaried position to a commission-based one. Don't even accept a promotion at a new company if you can help it. Underwriters value stability above all else. A change in job, even a good one, introduces a new variable and can torpedo your entire loan at the 11th hour. Lenders will do a final verification of employment, sometimes on the very day of closing, and if they find out you no longer work there, the deal is dead. Second, do not take on any new debt. This is the big one. You've been approved to buy a house, so you start thinking about all the things you need for it. A new couch, a new refrigerator, a new lawnmower. The temptation to go to the furniture store and take advantage of their no interest for 24 months offer is huge. Resist it. Do not finance a car. Do not open a new credit card. Do not co-sign a loan for your cousin. Any new debt or even a new credit inquiry will show up on a final credit check. It will alter your debt-to-income ratio, and the underwriter will have to recalculate everything. I have seen deals fall apart, literally the day before closing, because a buyer went out and financed $7,000 worth of furniture. Their DTI was pushed just over the acceptable limit, and the underwriter had no choice but to deny the loan. Wait until after you have the keys in your hand. While the underwriter is dissecting your financial life, a parallel process is happening. The property appraisal. The lender will hire an independent, third-party appraiser to determine the fair market value of the home you want to buy. This is crucial because the house itself is the collateral for the loan. The bank will not lend you $400,000 for a house that's only worth $375,000. If the appraisal comes in at or above your offer price, everyone breathes a sigh of relief. But what if it comes in low? This is called an appraisal gap, and it can be a major roadblock. If you offered $400,000 but the house only appraises for $380,000, the lender will only finance based on the $380,000 value. You have 3 options. You can try to renegotiate the price with the seller. You can come up with a $20,000 difference in cash out of your own pocket. Or if you have an appraisal contingency in your contract, you can walk away from the deal and get your deposit back. After what feels like an eternity of sending documents, answering questions, and holding your breath, you'll hopefully receive something called a conditional approval. This is a great sign. It means the underwriter has reviewed everything and is prepared to approve the loan, provided you can satisfy a few final specific conditions. It might be one last bank statement, an updated pay stub, or a letter of explanation for something minor. You clear these final hurdles, your file goes back to the underwriter for one last look, and then you get the 3 most beautiful words in the entire home buying process: clear to close. This is it. This is the official green light. The underwriter is satisfied. The lender has fully approved your loan and is ready to send the money. All the stress, all the paperwork, all the waiting, it was all worth it. The finish line is now finally in sight. You're no longer just a hopeful buyer with a pre-approval letter. You're a fully vetted, approved borrower on the verge of getting the keys to your new home. And that final step, that moment you've been working towards, is called closing. But before you can sit down at that big table and sign your name 100 times, there are 2 critical milestones you have to pass. Think of them as the final checkpoints before you cross the finish line. First up is the closing disclosure, or CD. This is one of the most important documents you will receive in the entire process. By law, your lender must provide you with the final closing disclosure at least 3 business days before your scheduled closing date. This isn't a suggestion. It's a federal requirement designed to protect you. Why? Because the CD is the final itemized bill for your home purchase. It spells out, down to the penny, your exact loan terms, your final interest rate, your monthly payment, and a complete breakdown of every single closing cost. This is your moment of truth. You need to take your original loan estimate, that document you got way back at the beginning, and compare it side by side with this closing disclosure. Are the numbers the same? Have any fees changed unexpectedly? Lenders are legally restricted from significantly changing certain fees between the loan estimate and the closing disclosure without a valid reason, like a change in your loan application. This 3-day window is your non-negotiable time to review everything, ask your lender questions, and dispute any discrepancies. Don't just skim it. Read every line. This is the final price tag on the biggest purchase of your life. Make sure you understand it completely. The second checkpoint is the final walkthrough. This usually happens 24 to 48 hours before closing. This is not the time to be shy. You, along with your real estate agent, will walk through the property one last time. You're not there to imagine where your couch will go. You are there on a mission. You are verifying that the home is in the exact same condition it was in when you agreed to buy it. You're checking that all the appliances included in the sale are still there and are working. Most importantly, you are confirming that any repairs the seller agreed to make have been completed satisfactorily. Turn on the faucets, flush the toilets, flip the light switches. If you negotiated for that leaky pipe under the sink to be fixed, get on your hands and knees and make sure it's dry. If you find a problem, a new hole in the wall from the movers, or a repair that wasn't done right, you need to raise the issue immediately with your agent. This is your last point of leverage before the home, and all its potential issues, becomes your responsibility. Once you've approved the closing disclosure and the final walkthrough is complete, it's time for the main event. Closing day. You'll go to the office of a title company, an escrow agent, or an attorney. You'll walk into a conference room, and you will see a stack of paper on the table that will make your heart skip a beat. Don't be intimidated. You've done the hard work to get here. This is just the paperwork that makes it all official. So what should you bring to this signing ceremony? First, and most importantly, the money. You can't just write a personal check for your down payment and closing costs. You'll need a certified check or a cashier's check made out to the title or escrow company for the exact amount listed on your closing disclosure. Your lender will tell you the precise amount and who to make the check out to. Second, bring 2 forms of government-issued photo identification, like your driver's license and passport. They need to verify you are who you say you are. And finally, bring your patience and a good pen, though they'll likely provide one. You're about to sign your name more times than you have in the last year combined. Sitting at that table, a closing agent will walk you through the mountain of documents. While there are many, 2 of them are the true superstars of the show. The first is the promissory note. This is your IOU to the lender. It's your legally binding promise to repay the loan, detailing the total amount you owe, the interest rate, the payment schedule, and what happens if you fail to pay. This is the document that creates the debt. The second is the mortgage, or in some states, the deed of trust. This is the document that secures the debt. It gives the lender a security interest in your property, which means if you don't pay back the loan as promised in the note, they have the legal right to foreclose and take possession of the house. Together, the note and the mortgage are the 2 pillars of your home loan. You'll sign, you'll initial, your hand will cramp up, and then it will be over. The closing agent will gather up all the signed documents. You'll hand over that massive check, and in return they will hand you a set of keys. And in that moment everything changes. The months of saving, the credit score obsession, the endless open houses, the stress of underwriting, it all melts away. Holding those keys, you are no longer a mortgage applicant. You are a homeowner. It's a profound, incredible feeling. But the journey isn't quite over. Being a homeowner means new responsibilities. Your first mortgage payment is often due on the first of the month following your closing. Sometimes, if you close late in the month, that first payment can be due in just a few weeks, so be prepared. Your lender will send you a welcome packet with all the information you need to set up your online account and make payments. My advice? Set up autopay immediately. You never want to miss a mortgage payment. You'll also need to understand your escrow account. For most homeowners, your monthly mortgage payment isn't just principal and interest. It also includes 1/12 of your annual property taxes and your homeowner's insurance premium. The lender holds this extra money in an escrow account and pays those bills on your behalf when they're due. It's a convenient system, but it's important to review your annual escrow statement to make sure there are no major shortages or overages. Finally, take all that paperwork from closing, that entire folder of documents, and put it in a safe, secure place. A fireproof box or a safe deposit box is ideal. You will need these documents for your taxes and for your records when you eventually sell the home. And that's it. From a simple dream of owning a home, you've navigated one of the most complex financial transactions of your life. Let's just take a second and look back at how far you've come. You started by understanding the bedrock of your financial life, your credit score, your income, and your debt-to-income ratio. You learned the language of loans, differentiating between FHA, VA, and conventional, and deciphering the puzzle of fixed-rate versus adjustable-rate mortgages. You transformed from a window shopper into a serious contender by getting pre-approved, proving to sellers and agents that you were the real deal. You shopped for rates not just based on the lowest number, but by understanding the entire picture of points, fees, and the annual percentage rate. You submitted your application and braced yourself for the deep, invasive dive of underwriting, providing every document they asked for until you received that magic phrase, clear to close. You reviewed your final numbers on the closing disclosure, walked through your future home one last time, and sat down at that table to sign the papers that turned a for sale sign into a welcome home mat. This process is a marathon, not a sprint. It's designed to be intimidating. It's filled with jargon and hurdles that can make anyone feel overwhelmed. But the goal of this entire guide wasn't just to give you definitions. It was to give you a roadmap. It was to demystify the process, to pull back the curtain, and to show you that you are fully capable of navigating this system with confidence. Owning a home is so much more than a mortgage payment. It's stability. It's a place to build memories. It's the single greatest wealth-building tool available to the average American. And now you don't just know the steps. You understand the strategy. You are no longer a beginner. You are an educated, empowered homebuyer, ready to take control of your financial future. If this guide gave you the clarity and confidence to start your own home buying journey, do one thing for me. Share it with one person you know who's dreaming of their first home. Let's demystify this process for everyone. And be sure to hit that subscribe button, because now that you know how to get the mortgage, our next series is all about how to pay it off faster than you ever thought possible. Your journey is just beginning. Go get those keys.